Learn from some of the great minds of the world. I caught that. It's not me, but there are some people here that are definitely gifted. Okay, just a couple of fine points. 2 weeks from now, Millionaire is due. So your 10 favorite quotes from Millionaire Next Door and why they were inspiring to you. Look forward to getting that. And then we're about a month away from the end of the class, and we have the most unique final paper, I think, of any final you've probably had here at BYU. It has the potential to be the most important thing that happens to you at BYU. And that essentially is to figure out what your signature strengths are and apply them in a creative way that you haven't maybe yet in your life as you're reaching out to help people. And it's my feeling that if you really do find that thing right at the center of those circles, and you find a creative way to do that, it has the potential to change the way you view life for the rest of your life, and will make a serious difference in being happier and doing things that are truly profound for you, which might be different than me or Misty or Curtis, and that's the thing. There's some individual things here to figure out. Well, in symbolism of that, I just wanted to show 2 minutes. It's basketball season. My all-time favorite internet inspirational experience. It happened 3 years ago in Rochester, New York. I would guess everybody's seen it, almost everybody. I've seen it over 100 times. Seriously, I think I weep every time I see it, and I'll try not to this time. What I really appreciated about this real thing that happened wasn't necessarily the shooter of the basketball. It was everybody else around him that caused this just amazing thing to happen. And you'll see from the coach to the opposing team who really let him shoot, to his own teammates, to the fans, everybody. And this is the kind of thing that maybe not to this level of excitement, but close to it when you do find that thing that you're meant to do and are able to do it, whatever that might be. So let's throw this on. Hopefully we can get it.
We had planned to bring a story tonight about a prep school that prepares football players for the NFL draft and big contracts. But we're going to call an audible. We're going to switch sports tonight because we run across an absolutely amazing basketball player that we want you to see. Here's Steve Hartman.
Grace Athena High School in Rochester, New York has a new, most unlikely hero, a special ed student by the name of Jason McElwain. Jason is the basketball team manager. For the past couple of years, he's been assisting Coach Jim Johnson, helping with whatever the team needs.
And go!
Enthusiastic, to say the least. Despite being born with autism, Jason's father says his son has never had a problem expressing himself at basketball games.
I was always concerned that he might get a technical when they lose the game because he, started yelling or whatever.
Let's have a hard practice tomorrow. All hour and a half. Let's get ready for Kenya. Let's go. 1, 2, 3, 10.
Because he has been so devoted to the team, for the last of the season, Coach Johnson decided to let Jason actually suit up. Not to play necessarily, just to let him feel what it's like to wear a jersey. At least that was the plan. But with 4 minutes to go in last week's game, Coach Johnson stood up and pointed to number 52, Jason McElwain. After years of fetching water and toweling off other people's sweat, Jason was actually in a game. His first shot was a 20-footer from the right baseline. Was it close? Did you almost make it?
I like this here, God, please, let's just get him a basket.
His second shot missed too, but the third was a chunk. A three-point no-doubter. And Jason wasn't done yet. Not by a long shot.
If I wasn't there to witness it, I wouldn't believe it,
He comes back and just come water. That was hot as a pistol.
Jason ended up shooting 6 3-pointers. One right after the other. He had 20 points total, and each time a shot went in, his teammates and the crowd went a little crazier. His last basket, right at the buzzer, created total mayhem. Because he is autistic, Jason says he's used to feeling different, but never this different. Never this wonderful. Steve Hartman, CBS News, Rochester, New York.
That's pretty cool. Miracle? Maybe. Well, I guess the part that I like about it is I see people on a fairly regular basis that are helping create dreams in other people's lives. And it's a very moving thing. I don't see that much passion necessarily. That was kind of a one-time thing, but I do see elements of that often. And that's really what this class is about. It's not about making money necessarily. It's not about investing. It's not about having a great balance sheet. It's just about allowing you to have the opportunity to do things like this, whatever it is for you to do more often. Okay. Now, to do that, money does play a role, and so I want to start today by showing something from Dave Ramsey again. It's called Super Save, and it's the one thing I think he says. He even quotes at the end of this little video piece that I don't think you should be able to graduate if you don't know this, and I agree. So let's see this, and we'll talk about it a little bit after.
We teach you to save for three basic things. Number one is for an emergency fund. For an emergency fund. Number two is for purchases. Now, I know that's a novel idea. Doesn't mean I shouldn't ask how much down. No, you need to ask how much. If you can't pay for it, you aren't ready to buy it. Hey, I'm going to tell you, I'm going to mess with you all throughout these sessions. I'm going to be stepping all over your toes, so you might as well get used to it. The third thing we teach you to save for is wealth building. Building some serious wealth for your good, your children's good, your family's good, and the good of others. How do you save money? Well, the big thing is you got to start. And I'll tell you what, you better start right now. Right now. You look at this next page and you'll see exactly what I'm talking about. I'm telling you, look at Ben and Arthur here. Ben starts saving, he saves $2,000 a year. $166.67 a month at 12%, which when we get into the mutual section and investment section, I'll show you how you can do that easily. But he starts saving at 12%. Now, compound interest works kind of like this. I need your help. You follow with me on this, okay? If I take $1,000 at 10% interest, $1,000 at 10% interest. At the end of the year, this is not a trick question, when they send me my 10% of $1,000 as an interest check, how much is that check for? $100. Good, this isn't hard. If I left it in there, I'd have $1,100, $1,100, right? Now the next year, if I got 10% of that as my interest, it would be $110, right? So if I left that in there, now I have $1,210, right? So next year my interest check would be $121, right? So 100, 110, 121. That's compound interest. Every time the snowball rolls over, it picks up more snow and it gets bigger. So the next time it rolls over, it picks up yet more snow. And by the time it gets to the bottom of the mountain, it is a cotton-picking avalanche. So Ben, he saves $2,000 a year from 19 to 26. And you'll notice he quits saving at 26 years old. He only put in $16,000. His brother Arthur, on the other hand, has kind of goofed off. And he said, well, I'm going to get serious now. I'm getting late in my 20s. It's time to get serious about saving money. And he starts saving money 27 years old. You notice Ben after that has zeros, but he already got the snowball rolling. Because by the time he quit, he already had $27,000. Do you see that? So that snowball keeps rolling because it's already started down the mountain. It's picking up interest the next year, interest the next year, interest the next year. He's reinvesting the interest every time. Now his brother Arthur over here doesn't start till 27. At age 65, he has put in not $16,000, but $78,000. He has saved almost his entire life and still comes up $700,000 short of the guy that started early. Is that amazing or what? I mean, I think you shouldn't be allowed to graduate from high school until you can explain that chart. It would change the way we elect political leaders in this country. Permanently. It would change a whole bunch of things. See, that's pretty basic stuff. And some of you are going, well, now Dave, that's a real great example if I was 19. How many of you in here are under 25 years old? Under 25 years old. Hey, under 25 years old. Let me just tell you, I just made you a multimillionaire if you got that. I just changed your whole family tree if you got that. Now, for the rest of you, the point of the chart is not that you should have started, it's that you better start. If you're 29, let's go. If you're 39, if you're 49, if you're 59, let's go. You gotta start. And you gotta start where you are. You can't go back. If you could, you would, I would. I would keep my hair, okay? If I went back, right?
We get everything up now. How many are here under 25? Raise your hands. See, that's why I love this. Because a lot of times when you talk to people, or I teach people in Salt Lake at least, very few people are able to raise their hand. And so it's not as exciting, at least for me, because it is. Because most people that I talk with are 40, 50, 60, 70. They've been caught forever in the money trap. So at least they learn some principles and they're excited to tell their kids about it. But we've caught you. And you know now. You know now. But you got to fight the culture against this one. By the way, are there any math majors here that can help us with what exactly we saw about Ben and Arthur? Who's a math major that can help explain? Einstein figured this out and called this the most powerful force in the universe. At least I can't find any book that he wrote that says that, but I have seen enough to say he said that. I know he knew about some other pretty powerful forces. So, but, let's just say this is a powerful force. And this compound interest thing where you just keep it in and it rolls over and it picks up snow. Again, I mentioned to you it takes about 8 years before you see some pretty good stuff. If you can wait it and go 10 and 12 and 15 and 20, it's ridiculous. 25, it's insane. 30 years, you start adding zeros. And if generations of families can figure it out, it's just nutty. The last, 30, 40, 50, 60, 100. I've mentioned this about the Church of Jesus Christ of Latter-day Saints, who I think sort of figured this out in the early 60s, especially with a man from Alberta who was called to be a general authority here. And I think helped set some paths to save each year from all the funds of the church. But let's just say in the amount of money that we're talking about now in terms of saving as much as the church has over the years is ridiculous, amazing. And the amount that just that money earns is crazy. And that's sort of what happens if you're able to kind of figure this out early. And if you do it by the age of 25 and just start every month or every week or every year or whatever it might be, saving a little bit and investing it, because of compound interest over time, it's just nuts what can happen. Yeah.
So, this may be a tough question, but when you're in school, like most of us are, we're paying for school.
Yeah.
And probably working just to pay for school. How do we save money?
Well, that's a real good question. I'm just saying, you teach me something about yourself if you can. I mean, if you can in this environment, then I can pretty much guarantee that you will in the next environment. If you can't in this environment, I'm going to guess that you won't in the next. It's that connected. There's some of the things that we've talked about already, like measuring pleasure is a huge way to begin to save. It's finding out that you can have just as much joy and happiness by not spending hardly anything versus spending a lot.
Well, like, for example, my instance, I work on campus and everything that I earn, I save for my next tuition, so I'm like barely scraping by for spring semester tuition. So I'm just trying to figure out, how do you save money when you have to pay everything else for tuition?
Does it have to be everything?
That's what I'm asking, does it?
Yeah.
As far as school loans and stuff like that, what would be your suggestion?
I'll tell you what, can you stay after? Maybe we can get into that question. That would be helpful.
My big question that I run into is, I'm able to save. My problem is how to find an investment for it, because of the fact that my savings I plan on using for a down payment on a home. So it's not long term. I can't go to a mutual fund. I can't go to the stock market. I can't go somewhere where it's risky, because I have the risk of losing it all as opposed to actually being able to stay in long enough to make sure that it does what it's supposed to.
Yeah.
What do you do in that circumstance?
That's another good question. Are you going to stay after? I mean, the short answer is you probably shouldn't invest long term for money that you have to pull out in the next 5 years. That's the short answer. And then what do you do? Then we can go to there. Again, I want to emphasize what Mr. Ramsey just emphasized, and one of the ways that I can do it is to show you a couple of examples. One from the pink sheet, just the top. You might have read it already, but all that we did in the Wilson family was just simply what you read about in the first paragraph, and I'll give you an actual more of an investing situation from it next. A $2,000 sofa financed at 19.8% interest with minimum monthly payments will take 31 years and 2 months to pay off, and you will pay more than $10,000. The interest alone robs you of $8,202 that you sweat for decades to earn. In fact, you will have to earn about $12,000 gross. Remember, you get taxed on that, on your income, to net $8,202 for the interest just so you can have your $2,000 sofa. It's amazing how many people run their finances like this. What could possibly be worth paying 5 times its value? But it gets worse. This is the part we forget about. If you were to put that same $8,202 of monthly payments into a mutual fund earning 10% yearly over the same 31 years, it would yield $45,540 in personal wealth. Could you bring the screen up right now? That'd be all right. Thanks. And again, as I look at people that handle money wisely, and as I look at what we did as a family, it was just simply making that shift. It was just turning it around. It wasn't getting into debt, especially for things that go down in value. And instead of doing that, we just pull it and move it into a direction where you buy things that actually go up or appreciate in value and pay you money, possibly as well. Yes?
I'm really sold on the idea of saving money, but I mean, there's not really a mutual fund out there in the world right now that's earning 10% or even more than 3 or 4%. I mean, if we wanted to start saving long term right now, where was good?
Well, the key is to look at it long term. That's the big issue, because if you look at anything short term, anything's possible. You could earn 45% this year, and you could lose 30%. Unfortunately, we've looked at the latter rather than the former. But I can take any year and I can show you some huge returns, and sometimes not. So in the short run, anything's possible with any mutual fund or any stock. What you have to look at is the long run, which is the same thing that we just looked at here when we looked at Ben and Arthur. It's the long run in how you handle money consistently and putting it into solid mutual funds or stocks over time where you get that average over time of 10% return.
So you would still say put it into
Now, I shouldn't say, I'm not going to give you any super advice, but I'll just say generally you're in a beautiful situation now if you haven't really invested much before, because we're looking at historical earnings yields that are superb in the stock market. That doesn't mean that we won't see the market splash down a little bit further. I don't know where we're going to go in the short run, but in the long run I feel much healthier about an investment dollar today versus, say, 4 or 5 years ago. Yeah?
The S&P 500 index mutual fund has like an average return on investment of a little over 12%, and that's for like the past 60 years. So I presume like the Great Depression and everything, a bunch of other small recessions.
Right. In our little depression right now.
Yeah.
Let me give you kind of an overall example. In January of 1995, these are the kinds of things that we've done as a family and I've seen happen. Now, this exact thing didn't happen, although I love the company and I bought stock in them. I didn't do this exactly, but this is the kind of thing we always shifted to. And that if you do, I promise you that you will have peace with money, and at a given time, you'll be able to really choose to bless the world and not be stuck. 1995 in January, assumption we had $50,000 in an account, cash, what I call the holding tank, looking for investment possibilities. I noticed that at that particular moment in time, I could have bought a brand new BMW 328. Is it IS or SI? See, I know some of you guys know that better than I do. But including tax and licensing, a brand new one, and then 1995 would have been right about $50K. So that was one option, and that's fine. Many people make this option. Don't even think about anything else. Okay. Instead of that, I could have bought 4,167 shares of a company that I did buy a little bit during that time and that I liked a lot. And it wasn't an amazing company. It's a little company that came out of the Northwest called Costco. Now, at the time, this wasn't like a startup company or anything. It started in the early 80s, and my family's in the grocery business, so we knew Costco pretty well. I saw the opening myself soon after my mission. My dad took me down and said, this is a pretty good concept. 12 years later, they'd grown. And not only that, they developed some things that I could tell that were great in the industry and unique, and I felt like they were in a position where they had already surpassed anything Walmart had ever thought about. And maybe they weren't anywhere near as big as Walmart, but every time you saw the two together, Costco blew them out of the water. And I could sense that just one of the great things they did was they just minimized the SKUs, or the amount of units that went into a store. So what they had, instead of Walmart has tons of stuff, Costco just said, we don't need tons of stuff, let's just get the best stuff and get a ton of it. We get better rates on it, better margins for it, and still sell it at really low rates. It'll give us a higher margin, allow us to pay our people better so we can keep them. There won't be as much turnover. It'll be a better experience going to the store. It just made sense. So anyway, it was selling for about $12 a share in mid-January of 1995. So anyway, you could buy 4,167 shares for $50,000. Remember, when I went through cash flow, net worth, and Bhutan, I'm trying to think, at least in my mind, okay, I'm going to buy this thing. What's it going to look like on the balance sheet down the road? Is that asset going to hopefully appreciate or not? And if it's not, it's going to cost me money to own it. I don't want much of it. So to me, it made no sense to buy a brand new car or anything close to a very nice car, no matter what it felt like for a second, because I knew it was just going like that, and it would cost me a ton. In fact, the nicer the car, the more taxes, more insurance, and usually the more cost to upkeep over time. So anyway, here we are, 2009, and if I kept really good care of this car, I'd still have it. It'd be worth about as much as a nice pair of Nike tennis shoes now, but it would be worth something, maybe a couple grand. It would have cost me a ton over the years in tax, licensing, upkeep. So again, on the balance sheet income statement, it would not have been a good. You shouldn't even use the word investment with car. There are a few cars out there, if you're unbelievable cars, that may go up in value, but usually not if you drive them at all. Which is the utilitarian reason for getting a car in the first place. Costco shares, on the other hand, those 467 shares today, first of all, in January of 2000, there was a 2-for-1 split. So what that said was you double the amount of shares you had at half the price at that point, because the price was getting too high. A lot of people felt and wanted more people to be able to buy it. So at that point, I'm pushing, 8,300-ish shares, starting in January. In, I think it was March of 2004, they started paying out dividends. I think it was a 10-cent per quarter dividend at the time. Anyway, calculated out that you could buy, since 2004 up till now, you could have bought, if you just turned them around and bought shares, about 600 more shares, 600 to 700 more shares of Costco, which I probably would have done. And that would have put me right at about 9,000 shares today. 9,000 shares of Costco. So the balance sheet today, Costco shares, even during the meltdown today, still priced out to, I looked at it this morning, right about $41 a share. So on the balance sheet, and by the way, that was worth $70 last September. I'm not too worried because, of course, my initial investment was $50,000. I haven't done much since. So even today, I'm looking on the balance sheet at about $370,000 that it's worth. But not only that, the dividends are paying me approximately at 9,000 shares, $5,760 a year, paid out quarterly. So a fourth of that paid out quarterly. I may or may not buy more shares of Costco. I might just take the cash. That's taxed. The rest of it wasn't. So this is appreciated gains, tax-free until you sell it, at least. To me, it's so obvious that there's really one way to go. But when I talk to friends, they don't get that yet. But you do, right? Now. It's funny, when I was your age, I didn't really think about blessing people. All I cared about, I like to see dollars. It's crazy. Way more than cars. But nobody else is like that, hardly. I just want you to be a little bit more like that so you can take advantage of this great opportunity. Not every company is Costco. You don't always just buy a ton of shares of one company. But my guess is if you work for Costco and you were a manager of Costco and you're given free shares of, when I say free, it's part of your pay package. My next-door neighbor's a manager at Costco. Just started there when he was a teenager up in Seattle. He's a manager now. Owns whopping amounts of shares at Costco. In both a 401k, his retirement fund, and just normally. And he's, the company's been giving them to him over the years. And so these are good things. These are things that appreciate. again, over time and earn money. And for you and I, it's just a matter of thinking a little bit more clearly about what the future could hold for a particular asset or investment on your balance sheet. Is it meant to go up, pay you money back, that sort of thing? That's just one example. Let's go to the yellow sheet really fast here. Yellow sheet. What's it titled? Asset classes or purchases designed to appreciate and earn income over time. By the way, we probably need a car. We probably really do need a car. I don't know if we need 2 or 3 or 4 or 5 cars. We probably need at least one. And so that's something you're going to have to consider about how you purchase it again and what you decide to do. For me, it was always hard to buy. I wanted a car that could get me from A to B, and a car that would do it for a long time, cheaply. And that's been the driving force. I always didn't want to pay too much for it because I wanted to pay cash to minimize the future monthly cost. I didn't want any. And at the same time, I didn't want it to go too far down that balance sheet. So if you buy a $40,000 car, it goes down lots. If you buy a $7,599 car like I did 2 weeks ago, it'll go down to, actually I got a good deal. It'll probably still be worth $7,500 next year, maybe $6,800 the following year. No, not too bad, not too bad. I don't mind that. It's just a different way of looking at it. These are different kinds of assets meant to go up. This might be, at least in my mind, most of the whole array of real serious assets. I mean, there's other things like art and stuff, but the market for it, to me, isn't big enough to warrant it being legitimate. Now, if you became an expert in art, and you started dealing in art, maybe for a few real solid people, there's a kind of a market there. But unless you're seeing thousands, if not millions, of trades or interactions on a daily basis in the United States or worldwide, to me it doesn't feel like a market. And you can, like baseball cards. That was my first real foray into investing. And you can get ripped just because there's not very many people that are willing to buy those things. And they can always look at it and say, that's not a perfect card. I'll take 10 cents when you thought it was worth $5 or something, What you want is something a little more legitimate like you see here. U.S. large company stocks, small company stocks, mutual funds, real estate bonds, oil and gas, venture capital, foreign stocks, emerging market stocks, buying part or all of a closely held business, hedge funds, money market, CD, treasury, bills, precious metals, etc. Now, just to give you an example, there's right below that is my goal. My goal, I have all this whole array of stuff, and these goals have changed over time. I'm 46 now, and things are different than when I was 22. But with my financial advisor and us talking for a few hours, we thought that this would be the best way to diversify the Wilson family overall portfolio the best way. So that times when the market zigged, I'd have a few that would zag, and the whole thing wouldn't go down together. Now, we find when you have a global sell-off, it's a little bit more challenging, and you probably get some fallout, but it's not as much of fallout as if I had everything in, say, U.S. stocks. So this is what my particular portfolio is rounded out to be. Those are the primary assets, the first 5 you see there, and the other 3 are secondary assets. So a bigger percentage would be in the primaries, and a smaller percentage in the secondaries. And as things sort of change, we might manipulate or alter the weighting as we go by. And that's really what a financial consultant or manager does and how he helps people. I didn't have one for years, but I figured it was time at some point. Yeah?
How do you feel about finding a good financial advisor?
Question for Cal next week. I like somebody that's boring and honest to the core. And that's exactly what Cal is. That doesn't mean he shouldn't come next week. He's incredible. And but that's really what I look for. I mean, I tend to be a little bit more charismatic and passionate about things, and I don't want my volatility to be interrupted in a swinging market. I want somebody that just sort of understands the full array, understands it dispassionately, and is able to. And when I come to him and say, "Gee, I know we have, say, 30 grand right now to put in some market. I really like this thing. Here's what I know about it. Tell me what you think." And he very passionately tells me what he thinks. Mostly, he'll talk me out of quite a few things. And by the way, I would say 20 minutes of what he talks about next week is fraud in Utah. So be here just for that purpose. It's worth it. It happens all too often here. We've been called the capital of that. I don't know if we're quite that now, but we're darn close. And it's sad, but that is the case. When you become more when you do more investment, you'll get these hackles come up, and you'll sense it. But when you're not, those hackles come up, and you may jump into something that you shouldn't. And people that have been experienced usually end up with your money, and you end up usually without it at that point. But even that can be a learning experience. I just don't want it to make such a huge difference that happens a few times and you just bail. A lot of doctors and dentists I know make mistakes and just decide to forget about investing forever again. And that's not the right answer either. Okay. There were a couple questions about what to do right now. Here's a practical piece of advice on accounts. I just kind of thought about what we had done over the years, starting from, say, early 20s. We didn't necessarily have all these accounts, but earnings. Earnings comes in via check or direct electronic movement. Most people, it just goes into a checking account, and then you spend it all, and you're done. Okay? When you look at people that handle money-wise, they don't do that. And, for example, you might see 4 different accounts that this check may automatically be going into partially as you tell them to. One of them might be a 401k retirement account. Some of you that have worked full-time have seen this, where the company matches at some percentage what you put in. The company I worked 8 years for here in Salt Lake, I could put in up to 6% of my gross income, and they would match it at 50 cents on a dollar. So if I put in 6%, they'd match it 3% more, and so that's free money. And I would do that right up to 6%, just because I felt like I had better things to go with it after that, because I couldn't touch this till at least 59. But it was good to do because of that free money, and healthy. So one of the parts of that check would go right to there. 6% would go here. I also had a stock, I should say a discount online stock market or stock company that I started with a company called Charles Schwab. You're familiar with it. At the time, they were charging $30 to get into a buy and $30 to sell, which to me, I'd come from the environment of $200 back before the internet. $200 to buy any amount of shares of stock and about $200 out. So Schwab was one of the first to get into the discount world. It was $30. By the time I left them, there were companies where you could buy as much stock as you wanted for about $5 in. So I remember writing them a letter and telling them if they could come down a little bit. They didn't. So I went to a company called Daytech. I think it was about $8 to get into buying stock and about $8 out. And they were bought out by Ameritrade, who then tied in with TD Waterhouse. I think it's something called TD Ameritrade right now. So anyway, that's the company that I use for a discount brokerage house. It allows you to buy and sell stock. And they usually, with these accounts, they have a money market fund attached to it. So if it were my earnings again, a certain percentage would go into that money market account that was tied to TD Ameritrade. And as that grew, and then as I felt that I saw some really good companies at really good prices, which in my mind, when you talk about value investing, which is mainly what I do, I like pseudo-monopolies. I mean, I like companies that if you came in with best minds and billions of dollars, you still couldn't really root out the market share. A company like Coca-Cola may fit into that category. I mean, they've just been out there so long. Their name is so big that they're drunk by so many people worldwide that's sort of a pseudo-monopoly. And if you went in with Mitt Romney and $5 billion and 5 of his best business minds, you really couldn't still do a lot. That's the kind of company I like. But I still don't like to buy them until the price is at the level I think it should be. Because I don't want to pay too much, no matter how good a company it is. And so looking at those two variables, I mean, it'll take a while, but at some point, there'll be a company or two or a mutual fund that I really like at the right price. And so I'll use that amount in the money market fund and buy shares of that stock or mutual fund or bond or whatever it might be. And it's easy. I don't know if you guys have done it, but it's just a click of a mouse. It's almost too easy. And that's the problem. It's a very liquid world. That investment, I mean, you can buy and sell stock like that. And because of that, it might be a little bit more dangerous for stock. But again, we can talk about strategies later, even after the class. But But the reality is, the important thing is to bring money from your earnings and go north with it, as we talked about last week. And part of going north is money to be able to invest in. A couple other of accounts I would consider strongly that at least we use. One of them was a checking account. And I'd want to put the amount of money into that checking account that we would spend for the next month. And not make it so tight that it would be, we always run out towards the end. I mean, we'd have to fast or something for the last week. I just wanted the right amount, the amount that would cause short-term joys and pleasures. Usually we'd be doing things for free anyway, but it wouldn't be there'd be enough where we wouldn't sweat bullets either. And then finally, I wanted what I called, a fund where money would just be sort of held. Call it a holding tank or whatever you want. And what I wanted here was the highest risk-free rate of interest I could find. And I did find, this isn't a plug for Zions, but I've mentioned it before, I think. Zions has an account, I think we call it the Deseret Money Market account. Used to only be allowed for people outside the state of Utah. They brought it in, I think, a year or two ago. So the Deseret Money Market account that's always been right at the very highest rate of interest paid by any bank in America for their basically risk-free money market account. So I would pour money into that, and part of it would be the emergency fund, and the other part would be just money to be held as I'm looking around for investments. This emergency fund a lot of times should be, you hear a lot of professionals talk about 3 to 6 months of expenses just sitting there in case you have an emergency. And 3 months is adequate for me anyway. And then the rest would be held to wait, to look, to seize the day. Carpe diem. Yeah.
Approximately what rate are you getting in the Deseret?
Right now, it alters. Okay, what's the approximate rate we're getting? It varies according to the federal funds rate, and because the federal funds rate has been dropped so far, you're getting under 3% now. Maybe I think it's about 2.65 or something. I haven't looked the last couple of weeks. In a normal environment, you'd see somewhere around 5 or 6% coming from this. But that's still really high, given, I don't know if you guys understand, that's a pretty high rate given what we're looking at right now. Yeah?
If anybody's in Hawaii, we get a checking account that gives us 4.25% back.
Talk to this lady after. I'm not aware of that. Is that for real? I want it to be safe, too. I do a little more checking. That seems a little high for me for the current environment on a checking account. But when you say fluid, you're able to move money in and out up to 3 times a month.
Okay.
So it's not, so you can write checks on it. But I don't want to anyway. I'm looking. This is a pure investment account for me. Uh-huh.
You put 6% on your 401k account.
When I was working for a company that would match it.
What other percentage do you put in your investing versus checking?
So are you saying what kind of percentages would I be looking at here? Well, again, I'm a demon for trying to throw out more and more, if possible, into these kinds of accounts. But I wouldn't want any more. Most people only save here. And I think I've showed you that it's possible to get to a closer state of freedom before you're 59 if you handle money like this. So if everything went into there, you couldn't be able to touch it. So I'd rather just max out at what my company's matching here. So that would be the most I'd ever put here. And again, here I want the family to feel comfortable and okay. And so again, I'm not sure the percentage that would go there, but it would be a normal amount. I'd kind of figure out. And by the way, when you live a debt-free lifestyle, it's not nearly as much as you would think going into these needs or requirements for the family. I would probably look at most of it going here. If I was more into the stock buying mode, I might put more of it here between these two. Just the percentage would change given the situation of what's going on. But again, most people, it's just that, and that's all they think about. Even though they understand maybe the principles of what we talked about, but when you only put it there, by the end of the month, I promise you that'll pretty much be gone. You won't have anything else to go out with. Things happen automatically at the beginning, and that's how they work. Yeah.
Do you recommend keeping CDs?
CDs?
Yeah.
For certain people, yeah. Because it's kind of hard to move out of CDs. You know, you have to be in there for 3 months, 6 months, 9 months, a year, or longer. If you're good with money, you lock yourself into a rate there that can a lot of times be a bit lower than that. So this is a lot more freeing. But if you're going to take that, and blow it on liabilities that amassed as assets, then I'd have you go to a CD, so you're not really able to touch it. Yeah.
If you keep 3 to 6 months worth of money in your holding tank, the money market, where do you refill that account from? Where are the funds coming from that you put in that account?
They would be coming from here eventually if it's needed. So say you use this right here, you fund it from right here immediately, or if not, you go right from here. And again, if you're handling money wisely over a period of time, there's plenty of cash to refill it immediately from wherever you want to. We've needed that on occasion, but maybe we've been lucky or blessed or whatever. Once that emergency account has been established, we haven't needed it too often. But it does happen. It happens to everybody. It happens to everybody. So you need to have it. If you don't have that, you don't have the requisite cash, you'll probably pull from long-term investments, which is a real mistake. Darn, we're down to 2 minutes. Are you kidding me? We haven't even gone through this. I wanted to say that to get started with buying, purchasing, understanding stock, my favorite place is Motley Fool. It's on the internet, and it's also on this favorite literature. The website is right here on the top. I think it does a really good job of explaining when you're ready to really become a long-term investor. Pass, go, no, not yet. When do you get to pass, go, no, not yet? Now you do. And now that you're there, what are all these different kinds of stock plays that you could actually buy or sell or whatever? And it's all really listed on it. There's 13 steps. Go through one step at a time. It's kind of fun reading. It's not that dry like most investing books. And so I think you'll really appreciate it. I want to make a plug for the little book that beats the market. This is it. It's little, it's small. It's by a guy named Joel Greenblatt, who's an adjunct professor at Columbia University and teaches an investing class. I'd have you all go there to take the class if you could. It's just the way that we've kind of done it, and it makes it very simple to look at and understand. And we can talk a little bit more about it if you want to stay. Darn it, we're done. That's all we can do today. Thanks. See you next week.